Good afternoon and welcome to the third webinar organized by the International Business Tax Center. As you know, we have been already working with other webinar organized in the months of March and April. The first one was about the transfer pricing in the era of COVID-19, and the second one was more about intercompany services. So this time we want to focus our workshop on one of the most discussed tax topic on the digital, which actually is the digital service tax. The structure of our webinar is as follows. We always start from with the case study, and this time we have a case study proposed by the head of tax of Fininvest. And then we go through the webinar with the contribution from institutions, in this case, from the European Commission, from the General Director of the Ministry of Finance in Italy. And then we go again with contribution from a multinational, in this case is Google with Mr. Trulli. And then we go with the academics from the University of Lisbon, Amsterdam, Luxembourg, and Italy. So why we want to focus our discussion today on this specific topic? Because we know how much crucial is this topic right now. Let me do a brief introduction on this topic, looking back what happened so far, what has been done, what was done so far, and what we will be doing in the next future. So we know already that in 2013 there was the launch of the BEPS project, and the outcome of that of the BEPS project was the Action 1 in 2015 about the digital services. Based on that, already in 2018, the European Union put out the draft directive on the introduction of the digital service tax, which actually the intention was, of course, to have this interim solution for the digital services tax in order to capture the value at the domestic level. Indeed, most of the countries so far who actually have implemented this digital service tax are from Europe. Indeed, we have Italy, which is actually this business case we want to discuss today. And then we have other countries like Spain, France, and even others. So after that, in 2020, we had the blueprint for Pillar 1 and Pillar 2, who actually basically are stuck, let's say, in the limbo, waiting also the negotiation, the international discussion. But right now, in the last months, something more happened. Apart from the COVID-19 and even the urgent need to cover the crisis caused by the COVID-19, we have right now in the recent months also some interesting news from USA first. So we all know about the proposal of the global minimum tax from USA on one side. And the first question in this case would be also how much, which can, if and now, let's say, the global minimum tax from USA can impact also the discussion of the digital service tax. And then we have we have also the communication adopted by the European Commission just last week about the business taxation and the tax agenda for 2023. So we have many news on the table. So this means that the discussion is still open. There are many variables aspects to be taken into account. And that's why we thought that could be an important step to do this webinar today. Even because the idea of the center is also to organize before the end of the current year, so before the end of 2021, convention and congress with all stakeholders involved again, and to involve more speakers and more institutions, more academies, in order to go into the details of this topic by the end of this year as well. So this is then an important step again. And that's why we want to start from the first presentation, which actually is the business case proposed by Dr. Trettel, and I give the floor to him just to start with our webinar. Please, Dr.
Thank you so much for your invitation. The purpose of my presentation is to explain how Italy has implemented the digital service tax proposed by the European Commission in March 2018. According to my personal working experience, I will focus on digital and targeted advertising scenario only, in a group largely Italy-oriented, and this makes everything simpler, believe me. I will share my presentation. So, it isn't the first attempt in Italy to ring-fence digital economy in order to get its revenue taxable. Different taxes involved in the past demonstrate how inadequate existing national rules are for bridling the digital evolution of the economy. The previous steps were the VAT approach in 2013, immediately repealed, the voluntary cooperation between the Italian Revenue Agency and the foreign entities for jointly identifying a hidden permanent establishment and quantifying its taxable income in 2017, the introduction of a new permanent establishment definition in 2017. After that, time had come to take on the European model. In this perspective, it has been considered as the solution which could have ensured a fair and effective taxation for digital service, even if temporary. It took about 2 years to accomplish the mission, considering that the legal framework was completed just thanks to the implementing regulation of the Director of the Italian Revenue Agency, published on January 15th, 2021, and to the circular letter number 3 of the Italian Revenue Agency, published on March the 23rd, 2021. Please note that this happened several months after the potential exceedance of the double threshold and the collection of incomes which are considered taxable. The requirements for being taxable in Italy are the following ones: to perform a business activity wherever, in Italy, in the European Union, or worldwide, to achieve a global turnover not lower than 750 million euros individually or at a group level. This threshold is the same relevant for the country-by-country reporting purposes, and it's a way for making the measure selective. Third, to receive both individually or at a group level at least 5.5 million euros of digital revenues, that is, revenues deriving from conveying targeted advertising on a digital interface, provisioning social networking services, and or transmitting data collected from and generated by users of a digital interface, as long as they are considered connecting with Italy's territory. Even if the Italian DST is clearly drawn from the original Commission proposal, it counts on a nearly identical terminology, similar exemptions and exclusions. It shows certain differences. This is the most relevant one, known suddenly at the beginning of the current year. It might create some problems, given that taxpayers are asked to keep separate accounts in order to record all necessary information for quantifying the DST due. I imagine that nobody was ready to this news, having an impact on something that happened in 2019 and in 2020, and it may not be worth changing computer accounting systems. Once these conditions are met in 2019, you are labeled as DST payer for the following year, 2020, whatever it happens meanwhile. That is, for example, getting out of a taxable group for becoming part of another one not taxable. It's pretty hard not to realize how non-proportionate this attempt seems to me. It doesn't care for the evolution of the European Union's approach. For example, in Communication 2018-148 final has become the Council proposal number 6873 of 2019. It pretends to forget that thanks to the so-called Milan method, the local revenue agencies' offices have been able to collect taxes and penalties from foreign digital companies anyway. But above all, an indirect tax is being asked to replace an income tax. But in my opinion, this shows that more probably the Italian implementation anticipates the evolution in EU approach, which aims to transform the digital service tax into an equalization levy, making it independent of the forthcoming international agreements or corporate tax reform. The requirement for being taxable, I beg your pardon, I made a mistake. On the three types of taxable digital services, I would like to deal with the first one, conveying targeted advertising. These are the further requirements to be verified. The digital service must not be for free, but not necessary for cash, for example, advertising barter. A digital device, a mobile phone, a tablet, a computer, or a smart TV, and a digital platform, for instance, a website or an app, are the necessary media. The services may consist of either brokering or hosting targeted advertising, and every person intervening throughout this value chain is liable. Only targeted messages based on user data are taxable when shown in Italy, with no regard to their nature. For example, social demographic, geographic, behavioral, and so on. Only the contextual advertising is the only excluded. It seems to be easy to quantify the due digital service tax. Its formula is simple. 3% of gross amount of taxable revenues received multiplied by a ratio representing the part of digital service connected to the Italian territory. But you could easily change your mind considering how many things this value chain might be composed of. In slide number 9, and number 10, the phenomenon is apportioned in more and more numerous components. Fortunately, although the taxable base is the gross price received, every person is liable for the part that it is allowed to retain. What are the difficulties still connected with its enforcement? First of all, it is a local and a temporary solution to a problem wildly felt and irreversible. In addition to this, the connecting criteria. Only the taxpayer should be entitled to choose the relevant one. Otherwise, the number of taxable cases could significantly increase. We can read the example shown on this slide. Consider, for example, the case in which Beta is a German resident having subscribed to an online newspaper to which he has provided certain information, including information relating to his residence and domicile, in order to open the account. The appearance of the advertising message on Beta's device can take place wherever the same is located, thus making a geographical localization necessary. In other words, the conveyance service will be relevant for the domestic digital services tax purposes if Beta views the advertising message while in Italy. This example is read on circular letter number 3 at paragraph 5.2. What is the consequence? If the newspaper is published by a German company, part of an Italian group which exceeded the double threshold the previous year, the company was required to pay within May 17th, 2021, the Italian DST on the advertising message published in cash in 2020. All other companies of the same group are held jointly and severally liable. The necessary data for quantifying the taxable base might be not homogeneous as far as their timing is concerned, for instance, in case of delayed payment or barter. The penalty protection should be extended in order to cover any behavior adopted in 2021 for avoiding not the payment for 2020, but the compliance cost any taxpayer should bear in order to respect the guidelines properly. The joint and several liability of resident entities belonging to the same group will reference to non-resident taxable persons' obligation, not necessarily aware, and its qualification as an indirect tax, which prevents the offsetting of credit surpluses with other taxes and the inclusion in the conventional scheme. I've finished my presentation.
Thank you, Dr. Tretta. So this is the case study that you wanted to propose, actually, is the Italian implementation of the digital service tax, and you have highlighted all the main aspects of the digital service tax. But now we want to go, of course, beyond that, and then we go with the contribution from the institutions. But before giving the floor to the next speaker, let me invite the participants, as well as also the other speakers, to feel free, of course, to make questions to the speakers, to interact each other. This means, of course, more, and this works more for the speakers here. And then we go with the contribution from Mr. Bert Zadendorp from the European Commission, who is the head of the Company Taxation Initiatives Unit. And the title of his contribution is The Global and the EU Challenge of Taxing the Digital Sector. Please, Mr. Zadendorp.
Thank you very much, Professor Vivona. It's a pleasure to be with you today. My only regret is from rainy Brussels rather than sunny Rome, but I think that's the modern reality we live in. I think you've chosen a very topical subject for today's webinar. I think as you undoubtedly know, digital taxation is very high on both the international and EU agenda, and important decisions are expected in the coming months, which are likely to shape the tax agenda for the coming years. So this is a very timely debate. I've been asked to focus mainly on the EU dimension of this work, but it's clear that our work has to be placed in the wider international context. So I think it would be a bit artificial to separate the two, particularly as we are very much committed to the international process that's currently ongoing at international level, the work of the inclusive framework. On both pillars, I should say, not just the establishing new rules on the profit allocation, but also the work on minimum effective taxation, pillar 2, which we both consider equally important from our perspective. I think I would just say a few words on, let's say, the recent history of our work in this area, the current discussions, and a brief look ahead in what's coming up in the coming months. Reference was already made to the communication on business taxation for the 21st century that we presented last week. So I'll say a few words about that, and I'll also say a few words about our work on the digital levy, the proposal for a new own resource. So if I could start very briefly with the history, which was already referred to by the previous speaker as well. This is not a new issue. We've been already looking at the issue of digital taxation, or the tax aspects of the digitalization of the economy, for a few years now. In fact, this was one of the actions that was identified in the context of the base erosion and profit shifting project, the BEPS project of the OECD. In fact, it was action 1, so I think that signifies the importance that was already attached to this issue a few years ago. And this led to the report on action 1, which I'm sure you're all familiar with, which I think for some was rather disappointing, because due to, let's say, the differences of opinion among the inclusive framework membership, it did not really propose a new way forward. It was very useful in summarizing the state of play and in providing some guidance to countries applying unilateral measures, but it didn't provide a path for a common way forward at international level. And I think because I think this was a disappointment to many countries, this led to calls for further action. Also at EU level, the EU finance ministers sort of called on the Commission to come forward with proposals, both for short-term and longer-term solutions. And this is what we did in 2018 when we came forward with a short-term proposal in the form of a proposal for a digital services tax and a long-term proposal providing for a reform of the corporate tax system in the form of our significant digital presence proposal. As is natural, because I mean the short-term measure was obviously intended to be implemented first, the discussions at the European level focused on the first proposal, the digital services tax. And although good progress was made in these discussions, it ultimately did not result in unanimous agreement at EU level. What it did do, or at least was one of the factors in relaunching the discussions at international level. So it gave new momentum to the international discussions, which led to calls by the OECD, the G20, to restart the work on the tax aspects of digitalization of the economy. So to pick up where the Action 1 report left off and try and find a way forward. So in that sense, I think this was a development we highly welcomed. And all EU member states, but also the Commission then sort of said, okay, we should give these international discussions a chance to deliver results. So we were very supportive and are very supportive of this international process that has emerged. This process was also helped by the fact that in the meantime, the United States, which was one of the countries which was, let's say, rather attached to the status quo, was undergoing a major tax reform of its corporate tax system, which was long overdue, at least according to many. So I think there was a greater willingness to discuss these issues at international level. And of course, another important factor was that the discussions at international level were broadened and were no longer only about sort of adapting the international corporate tax system to the challenges of the digitalized economy, but there was a new dimension in the form of a discussion on minimum of effective taxation, so-called Pillar 2. Another, I think, effect that we've seen from the discussions at EU level, particularly on the short-term measure, the digital services taxes, is that a number of member states, including Italy, the example was already mentioned just now, decided to take unilateral measures, sometimes more and sometimes less inspired by the discussions we were having at EU level, to introduce national taxes, digital services taxes, sometimes on the understanding that these were to be temporary, sort of waiting for an international solution to emerge. Sometimes that was less clear. And what we've also seen is that these national taxes have also triggered sort of further tension. They have triggered tensions at the international level, trade tensions. As the example of the trade actions launched by the United States against some of the national digital services taxes and equalization levies imposed by a number of countries, some of which include our EU member states. So this sort of set the scene for the discussions that are currently ongoing at international level on Pillars 1 and Pillar 2, where we had hoped to reach an agreement by the end of last year, but unfortunately, particularly due to the position of the previous US administration, this was not possible. But we now have clearly a new momentum in these discussions, with the new Biden administration engaging very positively in these discussions, and also coming with some new ideas, bringing new ideas to the table. Firstly, they sort of abandoned what was the main sort of stumbling block in the discussions. They abandoned the idea of the safe harbor approach, which was sort of imposed as a condition by the previous administration. So that was much welcome. But they also proposed a new approach for Pillar 1 in the form of a more quantitative approach, sort of replacing the more qualitative approach as outlined in the Pillar 1 blueprint, as adopted, presented by the Inclusive Framework. So these are important new developments which have clearly generated a new momentum in the international discussions, which I think to us suggests that there are very positive prospects for an international agreement to emerge in the coming months on both pillars. Clearly, there's still a lot of work to be done on both pillars. As regards Pillar 1, clearly there's still a lot of the details still to be sorted out, and we still need to know exactly to which companies the solution would apply. But the work clearly offers scope for simplification, which is important, and also for offering much needed certainty to taxpayers and tax administrations. So we're very positive about this work. There still remains work to be done over the coming weeks and months, but we're quite confident that an agreement can be reached, and maybe some of the details of that agreement will need to be further worked out in the course of the year. But this is work that is well on track, and the same goes for the work on Pillar 2, where obviously we also have a new momentum. I'm sure you've all seen the proposals that the US administration has made to change its existing corporate tax rules, its domestic rules, increasing the proposals to increase the corporate tax rate to 28%, but also changing its GILTI and BEAT rules, increasing the GILTI rate to 21%, doing away with the carve out for fixed assets, moving to jurisdictional blending. So these are all important developments which will have an impact on the ongoing discussions on Pillar 2, and increase the prospects for a successful outcome. So from our perspective, this is where I come to the third part. We are very supportive of the international process, as I've said. We hope that this will indeed result in a global consensus, and this is what we've announced and confirmed again in the communication on business taxation in the 21st century, which we adopted last week. We are ready to come forward with proposals to implement a global consensus on both pillars. Obviously, for that to happen, we need to have a global consensus first. So this is where our first priority should lie, to actually ensure that we reach this global consensus in the coming months. But then if and when we do, we are ready to come forward with proposals to implement this agreement to ensure a coordinated and consistent implementation of these new international standards at EU level. Obviously, a potential global consensus will also have an impact on existing unilateral measures. I think there was an expectation that this should be part of the overall compromise to be reached, and this is also part of the current ongoing discussions that if and when a global consensus emerges, particularly on Pillar 1, that then relevant unilateral measures should be rolled back, and we understand that this is all part and parcel of the ongoing work. This brings me to another issue that has attracted quite a bit of attention internationally, which is the work that we're doing on providing for new own resources for the EU budget. As you may know, last year there was agreement was reached also following the pandemic, which has affected our economies, all our economies quite considerably. There was an agreement reached for a large reform program, the Reform and Resilience Facility, with an envelope of some 750 billion euro. And obviously, this program will need to be funded, and one of the ways in which this new program will be funded is through new own resources to the EU budget. And in that context, the European Council, so member states have unanimously invited the Commission to come forward with a number of proposals for possible future own resources. And these proposals would include, for example, the idea of a cross-border adjustment, so in the sphere of green taxation, but also a digital levy. And the Commission has been asked to come forward with proposals by the middle of this year, with a view to having these new own resources in place by 2023. So generating revenues for the EU budget from 2023 onwards. So this is quite a tight calendar, which obviously has become even more interesting in light of the ongoing international developments in the area of digital taxation. This timeline, however, has been confirmed as recently as last March by the European Council, where they recalled this invitation to the Commission to come forward with proposals. So this is what we will do. Of course, we will deliver on this explicit mandate from the European Council. However, I think it is important to emphasize that the digital levy, the proposal for an own resource that we will come forward with, will be different from the digital services tax that we proposed in 2018. And of course, that also makes sense because it's a different animal. The digital services tax was intended as a short-term measure to fill a gap that was left by the fact that we didn't have this international consensus on a way forward in the area of corporate taxation. So it was always intended to be temporary in nature. And a digital levy as an own resource clearly has a different objective. Obviously, it has the objective of raising stable resources for the community budget. So it's not designed as a temporary measure. But I think more importantly, I think we also want to learn from the experience that we've made in the discussions on the digital services tax, but also from the national experiences of our member states. So you will see when we come forward with our proposal that it will be different from the previous proposals, that it will take into account the ongoing international discussions, that it will not interfere with the ongoing work at international level. It will not be our implementation of Pillar 1, let that be clear, but it will not interfere with the implementation of Pillar 1 if and when it comes. And we will also ensure that this proposal will be non-discriminatory. So it will not sort of suffer from we hope, from the criticism that the previous proposal faced, that it was sort of primarily targeted at a small group of non-EU digital companies, but that it will be broad in scope and apply indiscriminately to EU and non-EU companies. We are still in the process of finalizing our proposals. You will have seen that we had a consultation process, so there was a public consultation where you were all invited to comment, in which we outlined some options that we were looking at. So we received very helpful input from stakeholders in this process. And now we're sort of in the finishing straits of finalizing our proposal in order to be ready to meet the deadline to submit this proposal by the middle of this year. So still before the summer break. I'm afraid that at this stage I can't give you more details on the proposal. I wish I could, but I think I would be speaking ahead of myself if I did. But I think we are confident that when we come forward with our proposal, that we will not be seen as interrupting the very important international process which is ongoing, and which we very much support in reaching hopefully a global consensus that will then guide all our work for the coming years. I will stop at that, but I'm of course happy to answer any questions that you may have. Thank you.
Thank you very much. Yes, first of all, of course, I invite the speakers. If there is any questions from them, please feel free to raise some questions for Mr. Zadendorp. Anyway, let me thank you for this overview you did so far. Yeah, we all read especially the footnote 20, page 5 of the paper that you just released from the European Commission, where clearly is stated that the digital service proposal 2018 will be withdrawn. And then we look forward to so we leave the temporary solution then, and we look forward to see the structured solution that, as you said, will be certainly taking into account the experience done so far from member states. And if I remember correctly, it was just the 12th April when the public consultation was closed. And taking into account, hopefully, also the agreement and the international global consensus that you mentioned. So we look forward to that. So if there is no questions from the speakers or from the participants, I would then go to the next. Thank you again for your contribution. I would go to the next contribution, and I give the floor to Mrs. La Pecorella with the title for her contribution, DSTs and the Global Solution to Address the Challenge of the Digitalization of the Economy. Please.
So, as my friend Bert just said, this is in fact a very timely webinar dealing with the taxation of businesses operating in the digital sector is at the center of the international tax agenda, and it is and working for global and consensus-based solution is at the top of the priorities of the Italian presidency of the G20 this year. It is we are at a critical time in the negotiations for a solution, a few weeks before the deadline of mid-2021 that was set last year by the G20 leaders for achieving an agreement on the two pillars of the international tax reform. I should say that the starting point of the phase that is currently ongoing was the meeting of the finance ministers, of the G20 finance ministers last April, on the 7th of April, where they confirmed their commitment to achieve an agreement on the two pillars within this deadline. And I should add that finance ministers have shown to be aware that after many years of discussion, technical work, and after several postponements of the deadline for finalizing the negotiations, there is now the need for them to show the capacity to guide the global economy, providing a global response that addresses what has been identified as a global challenges. And it is precisely in this sense that in this game, what is at stake now is the legitimacy and the leadership's role of the G20. In addition, reforming the international tax system is critical now more than ever before, also in the perspective of setting back the global economy on a path of full and sustained recovery after the COVID-19 crisis. The common rules applicable that will be applicable to multinational enterprises operating at a global level under Pillar 1 will ensure the modernization of the existing rules on profit allocations, rules which are proved to be no longer fit for an economy increasingly digitalized and globalized. The key turning point in the negotiations was last April was the US proposal of defining using a comprehensive approach for defining the scope of the new rules, and this comprehensive approach is will bring in scope of the new rules only the largest and most profitable businesses globally. This has an immediate implication for the simplicity and the administrability of the new rules. Simplicity and administrability have been repeatedly indicated as the key features of the new rule by the business in the public consultations that have been held at the end of the year 2020 and in January 2021. the new scope of the new rules has the potential to respond to the call for simplicity and administrability, and to ensure that the new rules will be implementable. The new rules would also ensure the stability of the international tax architecture, and would provide, would be complemented by provisions ensuring the tax certainty to multinational businesses that is necessary for them to take the correct production and investment decisions. So another important element of the rules will be that the multinational businesses in scope of the new rules will be granted the tax certainty that is needed for business operating on a global scale. It was clear from the ministerial discussion at the G20 that the new rules will be will also include provisions for dealing with unilateral measures. And here, and there we have our DSTs. The DSTs that have been introduced as a response, as a reaction to the lack of a response at the international level on the definition of the new rules. The unilateral measures obviously have been adopted by a number of countries, including Italy, with full awareness of the fact that it was a suboptimal choice, taxing revenues of businesses operating in the digital sector in the absence of appropriate rule for the taxation of profits. Unilateral rules that have the potential of triggering negative effects also beyond the area of taxation, and in particular negative effects in terms of trade tensions. And in this respect, you will all know that our digital service tax is being investigated by the US Trade Representative. It's been deemed as discriminatory against US business, and the USTR is carrying forward its procedure has been carrying forward the procedure by identifying a list of potential goods on which tariffs could be levied as a response to these discriminatory measures, but has for the time being suspended the decisions on the application of the tariffs in view of the international agreement. And it is comforting to observe that very recently in the latest hearings that have been held in the context of these procedures, also representatives of the American businesses have concluded that have suggested that reacting to the Italian digital service tax with retaliatory measures was not the best idea, and in fact they've been suggesting in the context of the formal hearing to the USTR to wait for the global solution that is expected to be taken at the multilateral level. And this is another aspect that points at the importance of the discussions that are currently ongoing at the OECD level for the definition of the rules that will define the new profit allocation rules under Pillar 1. So, I mean, the new element in this discussion is the definition of the scope of the rules according to a comprehensive approach. An important element of the new rules will be the provisions of tax certainty for the multinational scope. Another important component of these rules will be the fact that with the implementation of the new rules will be not compatible with unilateral measures by the countries signing into this agreement. And this will, as I said a few minutes ago, will lead to more stability in the international tax architecture and will lead to also in more stability in the corporate tax revenues. The other part of the discussion focuses on a global minimum tax. The global minimum tax is it's been actually was discussed more easily in certain respects at the international level, and in fact the technical work on the rules that will ensure that multinational enterprises pay a minimum level of effective taxation wherever they operate are very advanced, a lot more advanced than the technical rules for reallocating profits under Pillar 1. But this discussion is witnessing a new and very important development in a sense with the push of the United States, of the new US administration. The global minimum tax is now becoming, now looks like a very important an achievement in this discussion. There is wide consensus on the fact that it has to be a robust, optimal, robust minimum tax, and very recently the United States Treasury has put forward the proposal that the international discussion should be as ambitious as to implement the new rules with a tax rate of at least 15%. This proposal was well received by a number of ministers, and you certainly you will have read the reactions of the French, the German minister, but also the Italian Minister of Finance has considered this proposal as an important step forward in the path towards an agreement. We know that we all know that the sensitivities around an issue as delicate as the rate of the global minimum tax are different around the table, but we think that, I mean, the perception is that everybody is aware of the fact that an agreement now must be reached, and must be reached at this meeting, with the perspective maybe of being finalized in technical details at the ministerial meeting in October. So this is what we expect from this discussion. The negotiations are ongoing in a very intense way, and we expect to, and we consider the prospect of an agreement in July in Venice as very concrete. With that agreement, we know that we will have then to start at the international level intense technical work for the quick implementation of the new rules. And with that, we will move into a new and different world. We will have, we will have the DSTs of which we are debating will be, will just will look like a relic from the past very soon, I hope. So, thank you very much.
Thank you very much for this overview and about, again, the international and the European debate and the domestic work done so far, because as you said, also the Italian implementation of the digital service tax was a reaction of the lack of response from the international debate. So, but yeah, at that time there was still, so the international debate was still stuck somewhere, especially in the relation with the US. Now, yeah, the international environment is different. And as you also briefly said and mentioned, now the challenge will be to see, the compatibility, the consistency with the domestic implementation that we have right now in place, and the potential new agreement that will be reached hopefully already next July or later on. Anyway, thank you, because so far what we have seen so far, we started from a practical aspect and the business case from the Italian digital service tax, and then we went through the international, still open debate and negotiation at the international level and the European level. And but now we add one more piece from the multinational, just to see where we are in practice before giving the floor to the comments from the academics. But now give the floor to Mr. Ciulli, who actually the title is contribution is online advertising, the Italian DST and the new international tax bill. Please, the floor is yours, Mr. Ciulli.
Thank you. Thank you for having me and for organizing this extremely timely and interesting conversation today. I will stick to the topic that was assigned to me, that Mrs. La Pecorella and the speaker from the European Commission raised some points that I will ask some question or some comments at the end of the presentation, because honestly it's so interesting also to debate. So I didn't ask question when you asked, because I know I was talking right after. So before enter into the details of what the Italian DST impacts the digital advertising ecosystem in Italy and how it differs from other DSTs in European countries, that will be my key area of focus. give me 3 minutes really to better understand what were the goals of this legislation and to see if they meet those goals. Because I've become old with DSTs in Italy. My first work and debates on this were back to 2013. And at that time, basically the issue that the legislator wanted to address was the alleged unfair competition of digital companies versus traditional companies, because they said digital companies do not pay enough taxes. And I want to firmly affirm here, I know all you are experts, but it is always useful to reiterate that it's simply not true. There is no real difference in the amount of taxes that digital companies pay compared to non-digital companies. Google, for example, pays more than 20% of effective tax rate globally. So I think that if DSTs are a tool to re-establish fair competition in the market, honestly, they are a solution for a problem that is not there, because most of digital companies actually pay the same or more taxes than their traditional counterparts. Then, and I'm happy that Fabrizia in particular raised this point, during the debate, another issue came to the attention that is more relevant to me, that is how business model change with the digitizations, and if a system where the taxable revenues are all taxed in the countries of production rather than in the country of consumption, if this is fair in a globalized model. We come from an international tax framework in which basically the vast amount of the taxes that Google pays, for example, is paid in the US for the very simple reason that our company originates in the US. Completely as Italian companies pay most of their taxes in Italy, or German companies pay most of their taxes in Germany. But of course, with new business models, there is more contribution of consumers. So we see that there is an interesting review in this system. And DSTs want also partially sometimes address this kind of issue. Of course, this is not it's an issue that has to do with the partition of tax revenues among countries more than the amount of taxes that single companies should pay. So by definition, they should not be resolved by additional taxation, they should be resolved by the international agreement. But in any case, I want to recognize here that also compared to other DSTs, the Italian DSTs is very much focused on this nexus. So, or identifying the value of created by consumer and attract that to taxation. I will elaborate more on this during the presentation. And it's important because it's relevant and partially differentiate Italy from other countries in which DSTs as mainly present as a tool for fiscal justice. That is something I really don't agree with. What are the three main differences I identify for Italy? The first one has been already highlighted by Dr. Trechter before, and that's the revenue thresholds. Different from in other countries, in Italy, both the revenue thresholds apply at the group level and not at the digital service level. And this is relevant because, at least from a theoretical standpoint, the Italian DST could be applied to a large number of Italian companies, because many Italian companies are relatively small and sell sell a small amount of digital services, but are part of big groups. And being the threshold in Italy at the group level and not at the digital services level, this makes happen that also small-sized company could fall in the scope. I give you a very easy example. Many Italian websites of recipes are part of a group, have relatively small revenues, but are part of big groups of all the publishing industries, like books, magazines, etc. So if they were in France, probably they would be out of scope. Being done in Italy, they are in scope, because the threshold are met at the group level and not at the single company level. The second important differentiation is that the DST, and this is really something that the first time that I see, recognize the specific business model of digital apps that are automatically served on third parties' content. I take 2 minutes more here because I understand it's complicated for tech people, from people specifically coming from the tech sector. Basically, when it comes to online advertising, you have 2 different scenarios. The first one, digital companies sell advertising on its own platform. So you are Booking.com, you are Google, you are Amazon, and you sell advertising on Booking.com, on Google, on Amazon. That's a fairly straightforward scenario. So your business model is selling your advertising. And of course, it is in scope. But the Italian DST is the only one, as far as I know, that introduced a specific differentiation for advertising that is served on third parties' websites. So in which the subjects who sells the advertising is different from the subject who hosts the advertising. Why it is important? Because it's how the reality is. So the vast majority of the advertising that you see in the internet are hosted by very different websites, and that are served by a big but smaller number of digital companies. And it's important to differentiate. Again, with an example, for the Italian speakers, if you look at the advertising on websites like Sole 24 Ore or the recipe websites that I was mentioning before, that could be served by Google. And in that case, there is a revenue sharing model in which typically Google takes 20 or 30%, in some cases 5% of the revenues, and the publisher takes the rest. So if you think about Sole 24 Ore, an economic newspaper, and you imagine that the revenue share is 80 to 20, but if an advertiser purchases 100 euro of digital advertising on Il Sole 24 Ore from Google, 20 euros goes to Google, 80 go to Sole 24 Ore. All the other web taxes consider as the taxable base of this the 100. And this has 2 impacts. The first one, they tax revenues that are already taxed in Italy, because basically those are revenues of Italian companies, of the recipe websites or of the newspaper and the publisher. Second one, this money has nothing to do with personal data, because the remuneration of personal data, of the use of personal data, lies on the amount that is taken by the intermediary. So if the taxable nexus is the leverage of personal data, and you will understand that in this 100 euro amount that an advertiser invests in ads, 80 is to purchase a space on an Italian website. That is nothing to do with the user, because it's the space on the web page of the Italian publisher. 20% could have to do with personal data, because the intermediary positions different ads depending on the users that views it. Could be complicated. I'm open for questions, but this is probably this is an important differentiation of the Italian DSTs compared to other, that make it more aligned with the notion of taxing consumer created value rather than tax justice. The second one that is super relevant is that the Italian DSTs, and even this is an exception, explicitly excludes contextual ads. What is, again, in the online advertising market, basically you could have two kinds of ads. The first one, an advertiser purchases an ad space depending on the context of the ad. So think about television. You purchase an ad on television because maybe it's on the afternoon and you want to target children, but you place it next to the cartoons for children, so you don't have access to user data. The same applies online. Maybe you purchase advertising on a sport websites because you want to be viewed by sport fans, but you do not have access to users' data. In the other case, you could purchase advertising related to users' data, so not related to the websites that host the advertising, but related to the users that specifically views it. This is a technical differentiation that is mirrored in the Italian legislation, and it's an innovation. It's an innovation that is critical. So it's okay in principle. It's super difficult to be implemented because in reality, advertiser purchases a lot of different format and different mix, but it's important to flag that here again, the Italian legislations try to identify the nexus with user data and to grant an exception to all the advertising that do not have to do with user data. The only exception to this, and I'm so sorry to say this, but it's the reality, they introduced an explicit differentiation for search engines. So for some reasons, search engines advertising technically is a contextual advertising, so should be excluded from the DSTs. But the Italian legislation introduced an exception for search engines. And this is quite a paradox, because for example, if you search on shop and e-commerce sites for Nike shoes, it's very likely that Adidas purchases spaces on the Nike shoes page, and you will see that Adidas. But for the sake of DST, that is out of the scope, because this is contextual, because it's related to the page of Nike. But if you search on a search engine, it's considered in scope because the users types the keywords. I don't have an explanation why this happened. This is what happened. And it's an exception, of course, that was introduced by the Italian revenue agencies. So these are the three main differentiations that I see that make firmly relevant that apart the exceptions and the criticism that we see as a company, but from an objective standpoint, the Italian DST is much more focused on identifying the nexus with user data. The concrete impact is that in the end, the scope is very narrow and very targeted to American companies. So the reality is that. Even if the revenue thresholds are higher, the business model based on user data is much more leveraged by American companies. And this is another fact. In conclusion, this was my question actually, it's interesting to see the update of the global debate and the OECD debate, because this resolved the two initial issues. The agreement on the minimal tax threshold for multinationals that, according to the last information, could be around 15% of effective corporate tax rate, resolves the issue of tax justice. Let me joke. I discovered this weekend that Google pays far more taxes than it should. We pay more than 20%, and now the accepted minimum threshold is 15%. So it's official that there is not a problem of tax justice. And I hope, and I think, I felt that we are also reaching an agreement at the OECD level on consumer-facing business, so on reassigning the remuneration of the tax money to the countries of destination rather than the countries of origin. We welcome this. As Google, we had advocated for years for an international deal. I am sincerely surprised, and this is my question, that even in the framework of an international deal, we still discuss of specific digital levies, because the international deal would cancel the political and legal rationale for this kind of levies. And in a framework in which, after the pandemic, etc., we all try to advance the digitization of our economies and try to convince European companies to invest more in digital, honestly, I feel like digital levy could not be coherent with these efforts and increasingly create delays in the digitization of the European economy.
Thank you, Mr. Ciulli. Thank you for going into the details also for the digital service tax and to make this comparison with the other domestic implementation that we have seen so far. Also for this last input about the international debate. So I will say that with your contribution, then we have provided a wider overview on the technicalities even about the Italian implementation. And if we had also the international debate that we have been discussing so far, so I think that we have many topics and arguments now to go through with the scientific professor here, and I'm really happy to give the floor now to Professor Dennis Weber, who actually will be discussing about the first thoughts on the European Commission communication on business taxation. Please, Dennis, the floor is yours.
Thank you very much, Giovanni, and thank you also that you invited me for this seminar. I'm on this program to say something about the communication of last week, and I was reconsidering a little bit because of the fact that we do not really have the technical details of the communication of the EU implementation of Pillar 1 and Pillar 2 in the EU digital levy. So what I'm going to do, I'm going to take a step back, and so I was considering and I was thinking about the fact that you see in literature a lot of literature already about especially Pillar 2. That is, of course, not related to the digital levy as such, or Pillar 1 as such, but you can always link together. And you see a lot of literature about the fact that the implementation of Pillar 1 and the implementation of Pillar 2 has to be in line with the fundamental freedoms and the state aid provisions. And when I was reading the literature and talking to a lot of people in practice and academics about this issue, I discovered that most of them, they apply the case law of the European Court of Justice until now about the EU treaty freedoms on Pillar 1 and Pillar 2. And I think that's incorrect as such, because cases like Lexel, cases like Cadbury Schweppes, and especially Lexel and Cadbury Schweppes are mentioned a lot, especially when it comes to Pillar 2. They are about unilateral measures. And Pillar 1 and Pillar 2 will be a multilateral measure. And that changes completely the scope and the whole discussion about the taxation as such. When you look to the case law of the European Court, and we had, for instance, the Van Hulten case. In the Van Hulten case, the court said, it is not unreasonable for the member states to find inspiration in international tax practice, and particularly the Model Convention of the OECD. So I think the court will also say the same when you talk about the multilateral instrument or the multilateral treaty that we will sign after Pillar 1 and Pillar 2. That are not unilateral measures, that are multilateral measures. So the court will have a completely different view about it. Now, that's for it. So I think that in the whole discussion, all those things about, is this in line with category swaps? It's not relevant, especially also that Pillar 1 is not an anti-abuse rule. It's about the minimum tax, so category swaps is not applicable as such. And also the Lexel case is not applicable because Lexel case was about tax avoidance, is not Pillar 2 problems, and it was about the balanced allocation of the power to tax. Now, of course, Pillar 2 is also about the balanced allocation of the power to tax, but completely different than Lexel, because Lexel was a unilateral measure in which the Swedish tax authorities were trying to say that they try to balance the balanced allocation of the power to tax. But imagine that you have Pillar 2 before the European Court, then that member state will not say, no, we are trying to balance the balanced allocation of the power to tax. No, this is the whole world that signed this consensus in Pillar 2, a multilateral treaty that will be completely different in the eyes of the European Court of Justice. So I would say throw away all those old case law about unilateral measures. They are not applicable at all in this whole discussion. That being said, there is also another case, because we saw in the communication, I have to go to the communication, of course, that Pillar 1 and Pillar 2 will be implemented in EU law by a directive. That also makes it completely different, but the directive is a multilateral instrument for the EU. It's our own multilateral instrument. And there is case law of the European Court. We have the so-called RPO case. It's a case about VAT, in which the court said, when the EU legislature adopts a tax measure, so imagine Pillar 1 or Pillar 2, then the EU legislator has got broad discretion to have the judicial review if it is in line with EU freedoms or not. Why? Because the EU legislator has to make a lot of difficult political, economic, and social choices. To have the complex assessments. And that's the reason why they have a broad discretion. And only when there is a manifest error, the court will say that it is not in line with the principle of proportionality or the EU treaty freedoms. So the EU legislator has a really broad discretion, not compared to unilateral measures by member states. And the court said in all full chambers, so the full chamber judgment, they say when a measure of the council could make an effective contribution to the goal that they want to try to achieve, it's already okay. That's a really broad discretion. Well, actually, so most likely everything that will be put in the EU directive is okay, or you really have to make what the court say a manifest error. Now, so the question is, and that's very important, of course, for Bert Zuidendorp and his colleagues, is not to make that manifest error. But they will not make a manifest error when they do not follow the case law of the court about unilateral measures, because unilateral measures is a completely different field. You know, this is not unilateral measure. So that's really important. Why is that important? For the carve-outs. I do not know if we have carve-outs in Pillar 2. I will come back on Pillar 1 later on. But there is a whole discussion, do we need carve-outs in Pillar 2? And the feeling is that you can only have carve-outs, that they always have to apply or follow the category swaps approach of the European Court of Justice. So they can only have carve-outs at the moment there is a wholly artificial arrangement and only those substance requirements. Now, I think that case law is not applicable. They can put every carve-out in Pillar 1, Pillar 2 that they want. For instance, they can, follow the carve-out that we saw in Action 5 of the harmful tax competition of the OECD. That is one of my concerns about Pillar 2. Now, we have a minimum tax, but all those measures that were peer-reviewed under the Action 5 report, and in which we said, okay, you can have those measures, those special regimes, are now suddenly, taxed away by the top-up tax under Pillar 2. I think it's very, very weird. Okay. That being said about Pillar 2, then back to the digital levy, because there was also, of course, the communication of the European Commission, the Pillar 2. Pillar 1, Pillar 1, we don't know where we end up because we have the new, we have the slides for us, the slides of the US. We do not have anything more, in which they broaden the scope of the Pillar 1 proposal. But I read in the newspapers that there is still a discussion about carve out, for instance, for the financial services, the financial industry, banking, fintech. And why? Because they are highly regulated, and they have a nexus in most of the states because they have to be capitalized and things. But is that really true? And now Werner Haslehner will talk about that later, but I think when you carve out certain industries, you have the problem of state aid. And I know that Werner will go deeper into that later on. And I know that there is a perfect case of the European Court on VAT, in which the court said that when the EU Council comes with an exemption or with a carve out, that could never be a measure of a state. So it could never be state aid, because for state aid, you need a measure of a state, not the measure of the EU Council. But I don't know if the court will hold up that case law if you really put in a new tax system a carve out for a specific type of industry that actually have to fall in, like fintech, under the rules. I don't know if it is there in the new Pillar 1 rules, but I thought, keep it into account and think it over. Then some small remarks about the digital levy. I know that it is clear from the communication, it's clear from the presentation of Bert Zuidendorp, that the EU digital levy will be something completely different than a digital service tax, completely different than Pillar 1. So we can a little bit guess now what it's going to be. It's not Pillar 1, it's not a digital service tax, so it must be a digital transaction tax. Don't know if it's business to business, do not know if it's business to consumer. There's no discrimination, there will be no threshold, I assume, but it's normally with a transaction tax, because you do not apply a threshold for big or smaller companies. So my prediction is that we will see on the 14th of July a digital transaction tax with no threshold and applicable to every online or digital, how you call it, transaction. Now, we did a lot of shopping last year on a digital platform, so yeah, I can see something here. There could be maybe a problem with the VAT directive, but you can amend that directive, of course, at the same time. The other thing is that this will be something of your own resources, and that's very important. I thought that the digital levy would be only in a limited amount of time, but from all the outings of the European Commission, I see that this will not be temporary. It will be always there. So this will be a new tax to not only to finance the recovery fund after COVID, but maybe also to have a stream of income for the EU after the recovery fund, after Corona, after 3 or 4 years. That means that we also need something else, actually. We need an EU tax administration, because how are you going to levy this? Okay, for now, maybe we can levy this through national law, what we also do with the VAT, for instance. It's also part of the EU resources, but I think it's very good, that's my recommendation to the European Commission, to not put this in a directive, put this in a regulation. Because if you put it in a directive, every member state has to implement this in its national law. If you put it in a regulation, you can, from scratch at the moment, it's adopted. You can levy this. very fast, and you do not have to wait for national implementation. Otherwise, we have to wait for national implementation. That's always going to take 1 or 2 years. That's what I wanted to say. Thank you.
Thank you, Dennis. Thank you. And I want to keep the discussion up, actually. I want to give the floor straight to Ana Paula, the Professoressa Ana Paula Dourado from the University of Lisbon. About the title is about some reasons to tax consumer-facing business. Please, Ana Paula.
Thank you very much. Good afternoon to everyone. It's a pleasure to be here and to listen to so many commentaries and novelties. And I'm taking now a different approach, hoping that it liaises with what has been said. I'm trying to move the gallery of our pictures so that I see my slides better.
We see your slides, yeah.
Okay.
Can you put in the presentation mode?
Yeah, will. Okay, so this is related to a series of aspects and lately to my research interest in recent years, connected, of course, with the developments that we are all seeing and looking forward to in one way or another. Differently to the main trend, I'm claiming for ring fencing. And connecting to what we heard before, I think that the path that both the international community and the EU is following is a mix of ring fencing and still trying to apply taxation of consumer-facing business without ring fencing. So some kind of intermediary path that is not clear. Dennis has just mentioned some examples, such as having this carve out for financial business, and well, we have other examples. Why do I claim in the direction of taxing consumer-facing business, so explicitly a ring fence way? Because it should play, according to my view, an important regulatory role. And this is mainly related to privacy and to need to protect personal data in democracy and in liberal states. So what we have as facts in the recent decades, we have the corporate size and dominance of technological companies, and they have been raising concerns in respect of unchecked power. These concerns are related with platform access, fair pricing, data privacy, security, national control of information assets, taxes, of course, and many other aspects that I am enumerating in this slide. And recently it has been very clear that there is an impact in democracy, and this is related to several needed instruments for us to have and keep liberal democracies, such as professional journalism, the need to avoid political polarization, and the impact of fake news. And all this is related to the fact that there is an interference in informational privacy. What are the options in these cases? We have one option related to enacting antitrust law, to prevent dominance, or in face of this specific business to accept that it is inherently monopolistic or oligopolistic, and then regulate them to prevent, for example, exclusivity arrangements, violation of data protection rules, and exploitation abuse. According to my reading and interpretation, the European Union has chosen to combine the two approaches. And we know that we have in the EU antitrust legislation applied to technological giants. And we know that this has been an area of growing conflict with the USA. The second approach, in contrast, accepts dominance and suggests regulation through public utility regulations. And according to my view, taxation could be one example of public utility regulations. So taxes here show up as a currency for jurisdictions to protect their citizens and residents' privacy in the aspect of informational privacy. This is very much related to interdisciplinary studies on the meaning and necessity of privacy in law, in psychology, in sociology, and so on. And it is demonstrated that manipulation endangers human freedom and development of individual personality. And this is related to manipulation of our data, or in other words, or in more correct words, to what is called data mining and knowledge discovery. So regulation of hate speech and protection of liberal democracies in their public sphere, as well as getting back sovereignty, would justify a taxation of consumer-facing business as such. So if this is the underlying justification, then taxation in this respect is similar to a royalty on intellectual property or on natural resources. And I also think that the value creation concept is therefore inadequate in the context of taxation of consumer-facing business. So when we are talking about taxation in the market state, it's not possible to come to apply this concept of value creation. And this would explain why, for example, Pillar 1 and the amount A do not really apply direct method. I would say that it's not possible, and it should be accepted expressly as such. Such a tax on consumer-facing business, having this regulatory role, it, however, also includes the purpose of collecting a revenue in market state. So it's related to the fact that our data have value, are valuable as such, even if we cannot apply this value creation concept. And I also think that this is independent of the urgently needed reform of the international tax system. If we look at the evolution of the international discussions, since the first reports and the Ottawa framework, for example, we can conclude that the discussion on the allocation of taxing rights was only prima facie related to the evolution of the specific business models in the digital economy. According to my interpretation, the genuine force that is leading all these discussions is connected to the internet model that we desire. And this is either free from obstacles, regulated, or autocratic. And we've seen that in recent years, the idea that the liberal internet model is a fact as such is not true anymore. It's utopian. We are facing several internet models, and we are facing, to a certain extent, some fight between a free internet model versus an autocratic internet model. Both are being exported to different countries and regions in the world. Since the last decade, the internet dominance by the technological giants has led to and is currently fueled by consumer-facing business. So we do have now this business model that we are talking about today, but also here we keep on talking, and the underlying worries are very much related to a free internet model. And this means that we have two main worries when we come to taxation. And these, the leading aspects are related, again, both to privacy and a liberal internet model when we are talking about the European Union. And there was this inertia all the way through, and this has meant that no reform of the international tax system, and at the same time the problem related with consumer-facing business, privacy, and all the negative consequences that come from that aspect. So fair allocation of taxing rights to market states in a digitalized economy where intangibles are the valuable assets is a very important aspect that requires international tax reform. But this is something different from the regulatory role to be played by taxes on consumer-facing business. So this is, the latter is an independent issue. In any case, what liaises both aspects, according to my view, is that in both cases, granting taxing rights to the market state will contribute to keep the liberal internet model and the liberal democracies, since if market states lose their or a relevant amount of revenue and ultimately their sovereignty, then the liberal internet model will not be the winner. The EU has been playing a relevant role in respect of regulating data, and again, I think that taxes could be a useful instrument to add to the existing ones. Thank you very much.
Thank you, Ana Paula. Thank you, Ana Paula. Just one question, because you were saying in the last slide, this one, you say granting tax rights to the market state will contribute to keep the liberal internet model. I was just thinking, of course, you also mentioned about the inertia and the international input it's urgently needed. But about the granting taxing rights to the market state, let's say, I was just thinking, how do you see then, based on this, if we look at this, do you say also that if it is linked, of course, in your view, the proposal from Dennis just before you to implement within the European context, to implement the digital tax reform, the digital tax rules through the regulation instead of the directive. So if you, in this way, you don't take some domestic tax powers away from the domestic itself, the domestic governance itself, and to leave this to the European Union. So do you think it's linked? Do you think the regulation is the right way to go ahead, or is the directive just to be more in line with the market, the domestic powers?
The regulation would have many advantages, of course, and Dennis mentioned them. I'm not sure this will be followed because the legal basis or the treaty basis for our directives, for our harmonization or for our tax measures have been the directives. I would be more aligned to this proposal by the Commission, or it's the Commission's agenda related to a qualified majority voting. So if we move from unanimity to majority, a qualified majority voting, then some of the problems that we have been facing will be away. But of course, Dennis also mentioned the fact that directives have to be transposed, but they have direct effects. So I don't think that's a big problem. It hasn't been a big problem in practice to transpose a directive since.
Dennis, you want to react?
One remark. Because we have to make a distinction between if we implement Pillar 1, that will be an income tax or an corporation tax, or when we talk about the digital levy of the European Commission. Because when we talk about Pillar 1, but I assume it's just corporation tax, then we can only implement it by a directive, because the legal basis has to be a directive for corporation tax. But but the EU levy could be something different. That could be an indirect taxation. An indirect tax you can also do by regulation. And I think when you have the chance to do that, and until now, for customs we did that by regulation, and that is part of the own resources. But for VAT, it's a mix. That's part of the national treasury and part of the own resources. But when you go now with an indirect tax, you want to have an own resource, EU own resource. Yeah, I think the best thing you could do is to do a regulation, because otherwise you can have always, okay, in general it works. I agree, directives, but yeah. You want to have that levy, the playing level field also between the states, I think, and then it could be easier. Maybe it could be easier. You have done. Otherwise, you have to implement in your national law. There could be distortions between the member states. France will do it differently than Germany. Germany will do it differently than the Netherlands, and Greece will do it differently. Then when you have a regulation, everything is the same. In theory, at least, of course. Then it's, of course, the national practice how you're going to do it, because we still do not have an EU tax administration, so it has to be levied by the national tax administration. So it also depends on their interpretation of the regulation. It's really a new thing for us to think about.
Yeah, absolutely. Good, thank you. So then let's go with the next contribution from Professor Werner Raslehner from the University of Luxembourg. We will be talking about digital service tax, illegal state aid, with a question mark at the end. Please, Werner, the floor is yours.
Thank you, Johnny. Let me start by not only thanking you for inviting me, but also already congratulating you to this wonderful event that you've organized here. It's really been amazing, at least so far. I mean, I'm sorry that I'm going to drag down the level a little bit here, but I mean, by this time it no longer matters so much, because we've had all these wonderful conversions already. I took so many notes, and I would have wanted to ask questions and comment much more, but I'll try maybe to do it a little bit and try to mix it a bit into my things that I wanted to say. On the last brief discussion that you just had there now, Anna Paula and Dennis, I wanted to maybe add one point that is more of a response to one of the arguments that Dennis made, which I generally completely agree with, the point that there is an over-emphasis or over-reliance, I think, in practice on the continued relevance and availability of case the Court of Justice with respect to things like Cadbury Schweppes, etc. And practitioners, of course, love Cadbury Schweppes, but that doesn't mean that it's going to be all that relevant in future. Related to discussion, directive or regulation, however, I think I would want to make the point in response to Dennis that, well, even if we do have a sort of agreement internationally, and that will change the way the Court of Justice will look at things, that agreement will not be complete. So there will be leeways, there will be sort of measures, there will be forms of implementation nationally in the same ways we have with a directive. And whenever we do have that possibility for differential implementation, the member states are, of course, fully responsible for the way they do that, both from the perspective of fundamental freedoms, which is what the perspective that Dennis took, but equally also, and he was alluding to the point, well, if we have something in form of a directive, then it's no longer stated. That's also, of course, in principle true, but to the extent that there is an option open for member states that they can exercise in a certain way, it's not so clear that it's not a measure that will be never imputable to the member states. So in many ways, the picture is, as always, and I think everyone is aware of that, is always a bit more complicated, and we are really tapping a bit in the dark when it comes to the assessment of measures that in many respects are completely untested and completely new and different from what we've had. So that's, I think, a general point I wanted to make. And then I'm very grateful to all the experts also from Italy who made a great attempt to explain a bit more now to me also how the Italian DST works, but it doesn't mean that I fully understood it yet, but we'll see. I actually have a very minimalistic presentation that I might try to share with you, if that works. I assume that it works unless someone tells me differently. Yes, so you can see this. I used your wonderful template that you provided me with. Now, there's not to suggest that I'm actually from your great university, but I just thought I'd use that for here. So a brief recap I wanted to start with. I don't know, time is always running away from me. So I don't need to explain to anyone what state aid means, really. I just thought I'll put it on the first slide, how it works. We have Article 107. We are looking to find, are there any financial advantages that are given through state resources, favoring certain undertakings, or indeed also certain sectors, and affect the trade between member states. We all understood this for a long time already, and we also understand for a long time that tax measures can equally fall into that. But in order to find the tax measure to actually give aid, we have to establish a difference to what would be the normal burden of taxation. So a tax by itself obviously is a burden on a taxpayer. It can only be sort of transformed into an advantage when it's less than what would normally be left. So the key question always is that we've had is, how do we establish what is normal taxation so that we can say there's something less than that is granted to only certain undertakings. So the core question, we've had that in all the cases before the courts, wherever the big discussion is, okay, what is our reference framework? And only then, once we have done that, we can determine whether there is a deviation from that, whether there are different forms of determining selectivity, of course. I don't want to go into that in any detail at all, but we'll have to find out what is the reference, what is it that we compare. And in order to do that, we are thrown back also to look specifically at the goal of the tax. And I'm very grateful there for the great presentation for Anna Paula to say, okay, what we are doing here with those sort of digital taxes, or with the consumer, broader speaking, the consumer-facing taxes, the justification for having them is regulatory nature. If indeed they are, if that is what they are doing, that changes our outlook that we have to take from the perspective of state aid, because it changes the objective of the tax of what we want to do with it. Now, that also depends on whether we fully agree with that view, and probably also a bit of a detail of what does it mean to say it's regulatory in purpose? Is that a direct regulatory purpose, so the tax itself should regulate, or is it the purpose to finance the regulation that follows from the tax? These are sort of subtleties that are very important there for us to determine whether we can have how we analyze such special taxes from the perspective of state aid law. So the issues that we have with sectoral taxes generally, and this is how I would classify or talk about DSTs and several of these taxes, they're really a tax on a particular sector. So the idea that we ring fence, we take out a certain part of the economy, that is a sectoral tax. We do have quite a bit of case law by the Court of Justice on different forms of sectoral taxes. When you say, okay, there are different ways of special taxes, most commonly different forms of environmental taxes. So the first category that you see in the slides, we had cases relating to energy taxes, where there was an energy tax rebate given only to manufacturing businesses and not to other businesses. The court said, well, you cannot do that. You cannot say, okay, manufacturing are different from services sector, and therefore you tax one or the other. Why can you not do that? Because the goal of the tax, which is energy tax, is to put a burden on energy consumption. And energy consumed by a manufacturing industry is no different from energy consumed by the services industry. Therefore, you have to treat both sectors the same in this respect. Actually, a pretty simple idea. The British aggregates saga that went back and forth between the General Court and the Court of Justice, etc., gives us something else that's important, and that is once we decide, so there's a lot of freedom, of course, for member states to decide what they want to tax. They have broad discretion in that respect because it's national tax sovereignty. But once they have decided that they have a certain goal and they want to impose a certain tax in order to achieve that goal, they have to be consistent not only in the concrete way of how they implement that, and we'll see that, but already within the general scope that they decide what should be part of the tax and what shouldn't be part of the tax. And the British aggregates levy was introduced as a tax on aggregates, which I didn't really understand what they were when I first read, but it's stuff that you dig out of the ground that is very important for the construction industry. And the environmental harm that was connected with that was, of course, that it's, it's harmful to the environment if you dig up holes everywhere to get out stone and gravel and sand and all sorts of different types of aggregates. But there were similar used products and similar used things that you could use as aggregates or would have similar harm that were not included in that tax. And the court just said, well, of course, you can decide about the regulatory goal that you have. You can see there's a harm there, but you have to have a sort of basis to decide, why is this harmful and this other thing that looks exactly the same for where I'm sitting? Why do you think this is less harmful? There's not complete discretion for member states for that. There has to be a certain reasonableness. There has to be a legitimacy in the basis they choose for taxation as well. They did have that, for instance, a good example of what is an easy thing to do, the German nuclear fuel duty, which was only imposed on the generation of nuclear power, that you could say sort of giving aid to every other energy producer. But the court accepted that as saying there is a particular harm that results from the use of nuclear fuel, because it has to be stored permanently in a way that is not the case for other sort of burned out fuel. And therefore, it is not comparable to anything else. Okay, so that's a general question. Can we have a sectoral tax? We can, we know that. Are there particular characteristics that are often considered to be problematic? And we have had several that were analyzed, and typically so far they've all found to be actually pretty fine. In the Spanish retail tax situation, we had a tax imposed only on big establishments, more than 2,500 square meters. And that, of course, could be considered to be aid being given to smaller establishments. The court accepted that, however, because there was a regulatory goal that was said, okay, it's only those big establishments which really, sort of not perfectly explicit, but it's sort of behind it, only those big establishments create environmental harm that we want to sort of reduce. Therefore, by taxing those bigger establishments, we're not really trying to have sort of a nefarious goal of taxing foreign businesses, but we really actually target those businesses that create environmental harm. Are differential tax rates acceptable? We have some cases there. We had this Irish air transport tax. Interestingly, it doesn't seem to have been a discussion. The Commission didn't seem to even check whether it would be acceptable to have a special tax on, for instance, the use of flying from Ireland. Presumably, that would also be justified by an environmental objective in the first place. But then having different tax rate or different tax amounts was not really rate actually, depending on whether you fly further away or closer, was considered to be aid because it was a sort of special group of airlines, of course, that had the short-haul flights primarily. And most recently, we had those cases that I think were awaited most eagerly for the people who think about digital services taxes potentially being aid, in the Polish retail tax and the Hungarian advertising tax cases, where we found, okay, these are effectively turnover taxes in a similar way to the DST. They had a certain level of progressivity, and the Commission was of the opinion that a combination of having a turnover tax with a progressive rate is in itself inherently a form of state aid because it's inconsistent. You either want a turnover tax that is sort of has nothing to do with ability to pay, and then you have to have a proportionate tax rate, or you have an income tax or something like an income tax that is ability to pay based. In that case, it makes sense to have a progressive tax. The court and actually the Grand Chamber of the Court just rejected that idea and thought there's no problem with having a progressive turnover tax. There's apparently such a thing as a turnover-based income tax, the court found, which I don't quite understand what that is. But Advocate General Kokot was very persuasive for the court in this respect. So trying to apply these lessons to DSTs, key to our analysis really, as I tried to say earlier, is what is the optional purpose of the DST? Do we want to capture untaxed profits from non-resident entities? So that is one of the goals that was said. It's about the allocation of taxing rights. Do we want to tax the user, that is the user value creation in the territory? That is sort of an argument that certainly was underlying the DST proposal of the European Commission. Do we want to impose a burden on the social harm, such as data use, over advertising? That seemed to be some of the suggestions that I hear from Anna Paula. There is sort of, in the use of data, there is the potential for manipulation and this threat to liberal democracy. So do we want to have a tax in order to prevent that? Or is it more of a sort of added consumption tax? Do consumers in a way benefit from getting free advertising? I'm sorry, you may lose my voice for a minute because can you hear me now again? Of course, my AirPods run out of battery in the worst time. So whatever it is, it will inform who is comparable or not. Only so if we have a regulatory objective, really, I think the scrutiny is likely more detailed as to whether you capture all comparable harms, right? And then one has to be very careful in designing what is it that you want to get. So I would like to have sort of pick up that point of discussion with Dr. Joly earlier, where I didn't fully get, okay, what is it now that is inside and what is outside? He made this interesting example of saying, okay, search engines are excluded or are included, but if you search not in search engine, but on another website, then that is included. That, for instance, is one of those dictas of like, okay, how can we justify such a differentiation? What is the difference from the perspective of the consumer, if it is the consumption or sort of the benefit that the consumer gets from a search service that we want to tax? What is the difference in terms of data use, if it's the data use that we are really concerned with, that we want to get to? What is it that we're trying to do and what we're trying to get to? This is, I think, the really key part, the complicated part. So if the Commission where to get. So I think the starting point is probably the other way around. If we do get common approval, as we've heard earlier, and get rid of all unilateral measures, probably there won't be a problem. No one will get anywhere. If member states get too attached to their DSTs or something like that, and they keep them, and maybe the Commission is trying to use state aid law to get rid of them, then I think we'll see some interesting questions as to whether those taxes have been implemented, created consistently, both in terms of what's in part of the base and what is part of how they are taxed in a rate. Generally, I think digital services taxes can be justified both as sort of redistributional taxes. So if we want to say we really want to just tax where the money is, so there are multinational companies, they don't pay enough tax on the corporate side, so we sort of have almost as a top up on our corporate tax, we use the DST. I think that can be justified. That's within the scope of national sovereignty to do that. But if that is the goal, then we have to make sure that it's consistently implemented like that. If it's regulatory in purpose, then it has to be, it can also be justified, but I think we have to look somewhat different at the scope of it. What about the Italian DST? Have I been speaking for too long already? That's or
go ahead. No problem.
So the Italian DST, as far as I understand, closely mirrors the Commission proposal that we had. Now, that does not, of course, make it in any way safe by itself. The fact, actually, and this was interesting earlier to hear from Mr. Dr. Sörentorp, that, or you also, of course, see it in the communication, and they say, well, you know, we got a lot of criticism that our proposed DST would be discriminatory, so we make sure that the next proposal we make is not discriminatory. So there's almost like an admission of discrimination that sort of certainly the United States sees very broadly, and many scholars also have tried to make the argument there's a discrimination part in these ideas of the DST. So that is certainly not saved in any way by the fact that the Commission had proposed it at some point. What's the purpose? The objective. So for me, it's not entirely clear. That was no one really explained to me very clearly what the purpose of the Italian DST is. Is it user value creation that should be taxed? Dr. Jolie earlier talked about it's the data use. So to me, these are two quite different things. Whether I use data, so I'm extracting the data sort of from a market, and this is where I generate my value from. That's different from the logic of value creation by users that should be taxed. Maybe that's a bit conceptual, but I think it matters because we want to know what the purpose is. If we don't know what the purpose is, we don't know, should this business model be in it because they make use of data, or should they be out of it because there's actually no value created by users other than them giving away their data? This makes a difference. Yeah, only once we know that, and so I don't fully know that yet, we can wonder about, has it been consistently implemented? And to me, that's not entirely clear. I was wondering, just reading a little bit what I could find in the implementation of the DST in Italy. One thing I was wondering about, for instance, that there's an exclusion, if I understand it right, for intra-group transactions. But it's not quite clear why that would be the case. Why does it matter whether a transaction is within a group or outside a group, to the extent that there's a use of data of Italian users, for instance? Maybe then afterwards there's a service provided outside of Italy, but Italian data has been used. Should that be taxed or not? Should it be outside of it? Any such inconsistency could potentially be harmful to the argument that there's a consistent implementation of a sort of underlying idea, and that would be potentially a state aid risk. But that's all I would say, and not really make any more detail.
Well, thank you very much. But if I can, I would ask you to share again the slides, because I want to take advantage from your slides and to involve also Anna Paula and Dennis, if they want, to comment on not on the last one, but the previous one. Not this one, of course, in the Italian DST, but on the previous one. Okay, this one. Because there are interesting question marks, and I would really be happy to get and collect the standpoints from Anna Paula and Dennis on those question marks. Please, Anna Paula.
Thanks a lot, Jenny and Werner. So what is the objective and purpose of the DST? You are speaking about the proposal, the Commission proposal, the old proposal, right?
Effectively, yes, because my understanding, the Italian DST, which I sort of was thinking about, is sort of this following the same idea.
Yes, so I do think that there is an underlying regulatory purpose. In my research, I go further than that. Well, it's not published yet, so I'm not going to announce too much, but I find that it's useful to have earmarked tax. And this digital levy that was announced today to us, and it's in the Commission also announcement, is not really a earmarked tax. So I would say it's halfway. I think that the reason for the Commission or for the member states to put forward this directive is related to regulatory purposes, but it's not fully consistent. I'm not sure whether member states are fully aware of that. I would say that it's related to the European culture in respect of regulation, data protection, and so on. It's also related to this report in France. I think it's from 2011, when they first studied this issue on consumer-facing business and started calling the attention to it. So maybe the underlying reason for this showing up is related to some regulatory culture that Europe has and the US doesn't have, for example. But it's not obvious here.
Mm-hmm.
Yeah, but what about sorry, Werner, please.
Would you then say it's effectively the idea is it's like imposing a burden on the social harm? Would that go into that direction? Like, because a regulatory tax typically says, okay, there's something that doesn't happen the way it should without intervention, so the government needs to intervene. Now, it's typically when we think there's a social harm that is sort of lessened, because if you tax something, less of it will happen, right? That's the idea.
Right, exactly. There is a social interest in having this tax in the market states. So this could be also underlying here.
Yeah. But Anna Paula, what about the concept of the value creation? Because you were mentioned also in your contribution about the value creation is inadequate from your standpoint in this context.
Right. This is related to what has been published about it. And I remember 2 years ago, or I don't remember any longer exactly, when I was organizing 2 seminars, Werner was there for special issues for Intertax, and value creation was one of the topics discussed. And of course, this was on the agenda because everyone talked about value creation, right? And Werner has just edited a book on that and so on. So, and suddenly when we had Pillar 1, the value creation concept disappeared. So we were all amazed because we were all trying to know what it meant. So value creation is very much related to intangibles, to transfer pricing, and we know that we know now when we see all these proposals that when we are talking about consumer-facing business and allocating taxing rights to the market state, that we have this formula or amount A or whatever the name you will call it, and the value creation is not there. And why not? Because it's, of course, it's not possible to assess how much value is created by us, by each of us, when we exceed the well, internet and social networks and so on. And because it's not possible to assess in terms of direct, so in terms of net value, it shouldn't be used here. And perhaps my background is related, and my intuition here is related to the experience I have in respect of petroleum and mining taxation when I was working on that as a consultant for the IMF. And many countries set up these, they called it royalties on the gross value of minerals and oil. And it was the gross value, not the net value. It was not possible to assess it in terms of net value yet. And the solution was to deduct those royalties from income tax later on. So I think there is a parallel here in terms of you know, how to assess our data.
I would totally agree with that. I think that is an excellent observation or insight, I think, into that idea. I wouldn't necessarily call that regulatory, because in a way, where also when companies or when countries try to get sort of tax revenue from extractive industry, they're not trying not to have extractive industry. They're not trying to regulate the amount of market. They want just to make sure that they get revenue from it. And there is, of course, also the connected need that there's actually something taken out from your society. This is always, that was a bit the difficulty for me with the analogy between, say, oil and data, that the oil is sort of, okay, you take it and it's gone, but the data is not gone. It's the data that I give somewhere and I still have it, and I can give it away again. So in a way, the analogy doesn't work 100%. The reason is, or the argument to me is okay, as a royalty, I like that logic. I just don't, I wouldn't, maybe we have different conceptions of regulatory tax. No, because for me, regulatory tax is sort of a steering tax that tries to steer behavior.
Right.
Let me collect the standpoint from Dennis on this slide, on the value creation discussion.
Gianni,
sure, go ahead.
Very briefly, I'm sorry, but
no problem, please go ahead.
These 2 points. I fully agree. It's only a partial parallel. Where is it? Because both mineral resources and data, in my perspective, are social goods. Okay, not so privacy. When I'm talking about privacy and informational privacy, this is not an individual right, but it's a social, a collective good related to our democracies, and very important to what Habermas, for example, calls the public sphere, that we are losing when we are talking about social networks and these tribes where, you know, we are talking with the ones who agree with us and not with the others and so on. So this is the parallel here, that it's not only an individual good, but social. Now, on the regulatory role, you are right. This is only applicable to data. And it's applicable to data because of these privacy concerns, which are not, have nothing to do with mineral resources. Sorry, Gianni, thanks.
No problem at all. Dennis.
No, I leave it up to Anna Paula and Werner. I'd like to add.
Okay.
I think we need to move on anyway. Time is running.
Yeah, that's true. That's true. So the last slide was about questions for the Italian digital service tax. So then I give the floor even to reply to the last slides. If you can them off from the screen, Werner, I think it's okay. And then we give the floor to Professor Alessio Persiani, and the topic is the digital service tax. The marketplaces and the Italian digital service tax. Please.
Thank you, Gianni. Thank you, everybody, to all the speakers, and thank you for inviting me in this event. It's very interesting, and this latest discussion between Werner and Anna Paula was very interesting on the DST. I will try to highlight some points in respect of marketplace. As you know, I hope that you see the slides. Okay, maybe this way. You know that we know that marketplace is one of the taxable service. More specifically, we have that make available to users of a multi-sided digital interface that allows users to find other users and interact with them, and that may also facilitate the provision of underlying supplies of goods or services directly between users. And this definition includes both social networking services and digital intermediation services. When we refer to social networking services, we are referring to those services where there is not a facilitation in the provision of goods or services. And when we refer to digital intermediation services, we refer to services where the interface facilitate the provision of goods or services between users. So we are referring to marketplaces, and we will now analyze more in-depthly the marketplaces and the implementation of this marketplace rule in the Italian DST. First of all, the Italian DST has been shaped after the DST directive proposal in respect of the qualification of digital intermediation services. So also in this case, we have a crucial role of the performance of the functions of an intermediary. And in the circular issued by the Italian tax authorities in March of 2021, we have a specific reference to whereas number 13 of the DST proposal in respect of the legal and economic substance of the transaction as reflected in the contractual arrangements between the parties. So as the Commission pointed out in its proposal, the existence of the inventory risk upon the interface, the entity is decisive, is crucial for qualifying the interface as an intermediary or not. And the same goes, and the same applies also for price setting functions. So if the interface has the power to set the prices of products it's selling, it can be qualified as not being an intermediary, because it would be a manufacturer or a supplier or a vendor, I would say, of the goods rather than an intermediary. On the other hand, if the entity does not have any power in respect of setting the prices of goods, because these prices are imposed or in some cases also recommended by the vendor, it can be said that the interface is acting as an intermediary, and so that the service that it is providing is subject to DST. Then we have in the circular we have a further reference, which, if I'm not wrong, it was not included in the proposal of the Commission, in the DST proposal, which is the reference to IFRS number 15, and specifically to paragraph B37, where we have some indicators of an entity acting as an agent. And I listed these indicators. So first of all, the fact that another party is primarily responsible for fulfilling the contract, the absence of inventory risk, the absence of discretion in setting prices, and this second and third points resembles the points of the whereas number 13 of the directive. Then the consideration in the form of a commission, and we, in this respect, we have also to bear in mind that IFRS is at the end an accounting principle, so it gives relevance to the approach which is taken, which is followed by from an accounting perspective, and so the circumstance that the consideration is accounted as a commission in the profit and loss account can be an indication for the qualification of the entity as an agent or not. And also the absence of a credit risk for the amount receivable with the interface is also an indicator that the interface is acting as an agent and not as a vendor of the goods. So these are more or less the general principle and the general qualification and the general principle for qualifying an interface as an intermediary or not, and for deciding if the service provided by the intermediary by the interface is subject to the DST in Italy. Now we have to focus our attention also on some carve-out clauses, and specifically on those carve-out clauses which are different from those of the directive proposal. First of all, we have the first carve-out, which regards the provision of underlying supplies of goods or services directly between users as part of a digital intermediation service. In respect of this carve-out, we can say that it is essentially aimed at, I would say, at identifying the taxable base of the DST. In other terms, we can say that this carve-out is aimed at identifying only the commission as the proper taxable base of the DST, and not the price for goods or services, because the price for goods or services should always be considered as out of the scope of the DST. So in other terms, this carve-out, I would say, is only a specification of the general principle according to which only an intermediary is subject to the DST, only an interface acting as an intermediary is subject to a DST, and an interface acting as a supplier or as a vendor and who is taking all the inventory risk and which is also setting the prices of products is not subject to DST. Then the second carve-out clause is the provision of underlying supplies of goods or services which are contracted online via the website of the supplier of such goods or services, where the supplier does not act as an intermediary. And also this carve-out as a specification of the general principle, because it's essentially aimed at carving out the so-called direct e-commerce. So the very best case of a supplier which is selling its own goods or services on its own website. Based on this carve-out clause, such a case would be out of the scope of the DST. But it also covers, for instance, provision of technological services or payment management systems. And also these services or systems the provision of these services should be considered to be out of the scope of the DST, based on this specific carve-out clause. And on this, I would like now to focus my attention specifically on this provision of technological services, because the circular includes an example which can be quite useful and also thought-provoking, I would say. If you assume that we have a company A which provides software or a digital platform to company B, and we have that the company B is the owner of the website because it has legal title to the domain name, and we have that the website, the company B also includes the software or the digital platform provided by company A on its website, and the website only displays brands and trademarks of company B. In such a case, according to the circular issued by the Italian tax authorities, the service should be out of the scope of the DST because company A is only providing a technical service, says the circular, a technical service to company B, and such a service should be considered to be out of the scope of the DST. And I think that this position is, I would say, I would agree with this conclusion, but I would also add one more specification. Would the conclusion be different if the company A, apart from providing the tax service, is also selling goods of company B, for instance, acting as a commissioner, so as an intermediary of company B? The first reaction, the prima facie, I would say, we would say that as company A, in this case, is acting as an intermediary, we could conclude that the service provided to company B in respect of the intermediation service is subject to DST. But we also, and this is my opinion, we also could support a different conclusion. We could draw a different conclusion on the basis of different arguments, because we are before a case where users are accessing the website of company B, and the users are attracted only by the brand and the trademarks of company B, because as I said before, on the website, only the trademarks and the brands of company B are displayed. No name, no trademarks and no names of company A is present on the website. And so this also means that company A derives no value from the user's access to the website. In this sense, if we assume, and I now also refer to the latest discussion between Anna Paula and Werner on the rationale underlying the DST. If we assume that the rationale underlying the DST should be only to cover those cases where the contribution of users to the creation of value for a company is more significant, and this is, as you know, an expression, a statement which is laid down under the DST directive proposal. If we assume that this is the rationale underlying the DST, we have that the company A is deriving no value from the access of the users to the website. And so we could argue that in such a case, the commission paid by company B to company A for selling the goods should be out of the scope of the DST, because, as I said, company A, there is no value creation for company A from the activity of the users. Coming back to our carve out clauses, we have two further carve outs in the Italian DST in respect of marketplaces. First of all, the ancillarity principle, according to which services ancillary to a principal service, which is out of the scope of DST, also is out of DST, is out of the scope of DST. So the ancillary service, first of all, we have to say the ancillarity should be interpreted according to VAT rules. And then, and so in this sense, the provision of a digital interface, for instance, which is part of a global service, which is not subject to DST and which is not autonomously remunerated, could be seen as a service ancillary to a principal service out of the DST, and so also the ancillary service should be deemed to be out of the DST. So at the end, this ancillarity principle is only aimed at excluding a service which would be theoretically included in the taxable base of the DST. Is only, as I said, is only aimed at excluding this ancillary service from the DST in case the service is ancillary to a principal service which is out of the scope of the DST. Please note that according to the circular of the Italian tax authorities, this principle it cannot be applicable in the opposite case. So if we have an ancillary service which is out of the scope of the DST, and which is auxiliary to a principal service which is included in the object of the DST, so which is subject to the DST. Also, the ancillary service would be subject to DST. So the ancillarity principle is only one way. One-way principle, and we can find the rationale underlying this ancillarity principle and the operation and the applicability of this ancillarity principle only in favor of the taxpayer, also in respect of limiting the compliance obligations for entities which generally provide goods or services out of the scope of DST. So this could be maybe the rationale of this ancillary principle and the function and the applicability of this ancillary principle. Then the second carve out, we have that fees paid as consideration for the sale of goods or provisional services, which on an economic level constitute operations that are independent of access to and the use of the taxable service. Also, these fees are exempt from the DST. The circular specifies that goods or services which are not that this statement, this exemption should be referred to goods and services which are not necessarily present anytime the user accesses to the digital interface and benefits from the service, and to goods or services which are having content substantially different from the digital service. Which we can try to single out some examples. For instance, a logistics service could be a case for the applicability of this exemption. So a logistics service could be caught by this exemption clause. The same could apply also for transport of goods, whose remuneration is included in the agent's commission. I'm specifying this point on the inclusion of the remuneration in the agent's commission because this exemption should apply in combination with the other exemption we have seen 1 minute ago with this one. This provision, when saying that only the commission is received by the marketplace is subject to tax, is also saying that any price and any remuneration for services which is not the intermediation service and which is autonomously remunerated and autonomously from the commission should be kept outside the taxable base of the DST. So this is the aim of the first carve-out clause. And in order to give an effet utile to this different exemption clause, we should assume that this clause is referred to remunerations and considerations which are included in the agent's commission. Because in the case, had this been excluded, the first carve-out clause would apply, and we should not apply this latest clause. Then one point for me very important in respect of the taxable base when we come to marketplaces in the Italian DST. The taxable revenues and the taxable base, is determined multiplying the overall worldwide amount of the revenues deriving from the digital intermediation services with the ratio between the number of supplies of goods or services provided in the relevant calendar year in which one of the users is located in Italy. This is the numerator of the ratio. And the denominator is the overall number of supplies of goods or services provided in the same calendar year. So now, if we take the DST directive proposal, we realize that the taxable base was determined in the proposal, giving relevance to the proportion of the number of users having concluded online transactions on the digital interface in that period. So we have a difference between the Italian DST and the proposal of the directive, because on one side we have the number of supplies in the Italian DST, we have the number of supplies, while in the DST directive, we have the number of users. And this is the first difference. Another point, which is not specifically different, but is relevant for the application of the Italian criterion, is that for having, I would say, an Italian supply, and so for the numerator of the ratio, it's sufficient that one of the users is located in Italy, according to the IP address and the all territorial rules which are provided under the Italian DST. So regardless if the user is the purchaser or the supplier of the service or the goods of the service. This is relevant because if we think to a very basic case, if we have 1,000 supplies with 1,000 Italian purchasers and 1,000 French suppliers, if we apply the number of supplies, so the criterion which is laid under Italian DST, we have that 100%, the ratio would be 100%. So we have 1,000 number of supplies in the numerator and 1,000 number of total supplies. So 100% of the overall taxable revenue are taxable in Italy. If we apply the different criterion which is provided under the DST directive, we have the number of Italian users is 1,000, and the number of total users should be 2,000 because we should consider both the Italian purchasers and the French suppliers, and the result would be that only 50% of the overall worldwide taxable revenues are included in the DST. So, which is the result? The result is that if we assume that the number of supplies, the criterion based on the number of supplies is applied also in France, in my example, we would have that a cross-border supply like this one would be subject to double taxation. On the other end, if we think to a purely domestic supply, so with both purchasers and supplier in Italy, it would be subject only to Italian DST. So in the end, we would have a detrimental regime applied to cross-border supplies as compared to purely domestic supplies in case of marketplaces. And the final thought is this a restriction? Yes, I would say this is a restriction, but I think we should think on the potential infringement of a free movement of services. Why? Because maybe we are not before a pure restriction, but we are before I would say a quasi restriction in the words and in the terminology of the European Court of Justice. So I would say that we are before a result from the exercise in parallel by two member states of their fiscal sovereignty. So in this case, these two criteria, this criterion of the number of supplies could result in a double taxation, which obviously is not desirable and should be eliminated. But I think that in case the European Court of Justice will not be in the position to eliminate this double taxation.
Thank you, Alessio. Thank you very much. Thank you for these other details about the Italian implementation of the digital service tax. It was absolutely the right way to conclude all the discussion this afternoon. We are 16 minutes beyond the timing that we promised to respect, but I give the floor to the other co-director of the International Business Tax Center, Professor Marco Fazzini, just to conclude. I thank you, of course, all the panelists on my behalf, and hope to keep working with you soon. The floor is yours, Marco.
Thank you, Gianni. Well, it's quite late, so don't be scared. I will not do any comment because it's late now, and I think that we have listened to interesting argumentations, and all the speakers have introduced many aspects that are really interesting both from taxation point of view and also from business point of view. So thank you to our guests, thank you to the participants, and see you next time. I give you the appointment for the next webinar that will be held next month. And really soon we are going to disclose the argument of our next webinar. So thank you so much, and have a nice week, and see you next time. Bye.
Thank you, Anna Paula. Thank you, Werner. See you soon. Thank you, Dr. Trettel.
Thank you.
Thank you.
Thank you.
Nice
Good
to
evening.
Thank you. Bye-bye.
Bye-bye all.